According to a recent Bloomberg report, the student debt crisis is about to take a turn for the worse as the next generation of millennial graduates could be in a debt trap. Let's take a look. Over the last decade, the federal student loan segment experienced an explosion in growth. As the cost of college soars, the result is an increasing default crisis that even Fed Chairman Jerome Powell recently warned burgeoning levels of student loan debt could slow down economic growth over time. Millennials have increased their student loans up almost 157% in cumulative growth over the last decade. By comparison, Bloomberg notes that auto debt growth was up 52%, while mortgage and credit card debt fell by 1%. Student loans now have breached the $1.5 trillion level, making it the second largest household debt segment among all Americans, only outpaced by mortgages. Analysts warn that a perfect storm in the student loan bubble is brewing. They say student loans are being issued at unprecedented rates as millennials are conditioned to believe that higher education is the only way to get ahead. This comes at a time when tuition at both private and public institutions is at record levels, and interest rates and loans are rising to new cycle highs. As the storm clouds gather, the next generation of graduates could default on their loans at even higher rates than today. And this chart here shows in the green, these are some of the lowest average loan debts, and they range from about 20 to 24,000. In the blue, those are some of the highest average debts, and they range over $30,000. Americans who attended for-profit universities and community colleges make up 70% of all the defaults, said Judith Scott Clayton, a Columbia University associate professor of economics. She said that poor working class folk were suckered into worthless degrees with the promise of a better job, but it only left them with high debt loads. She notes that delinquencies skyrocketed in 2011 to 2012 academic year, reaching almost 12%. This year, the rate remains near cycle highs, which she attributes to social and institutional factors rather than average debt levels. She further stated delinquency is at crisis levels for borrowers, particularly for borrowers of color, borrowers who have gone to a for profit school, and borrowers who didn't ultimately obtain a degree. Those most at risk of delinquency tend to be college dropouts and for profit graduates who struggle to find good jobs that allow them to pay off their balance. And in this chart here, Bloomberg Global Data Analysis of Federal Loans shows student debt has the highest 90-plus day delinquency rate of all household debt. In the next economic downturn, which could be late 2019 or sometime in 2020, the student debt bubble could experience a surge in delinquencies. 2018 has been a rough year for millennials as they struggle to pay back their debt obligations. Student debt has prevented some from having children or even owning a home. 16% of millennials aged 25 to 35 lived with their parents in 2017, and that's up 4% from a decade prior, according to Bloomberg Intelligence. While Wall Street and the Trump administration tout news of a roaring economy and low unemployment, the risks of a student loan bubble imploding in the next economic downturn could start in the second half of 2019. So for today, that's Chew Dog Charts. Thank you.